Asset allocation is the most important investment decision you will ever make. Why? Because 95% or more of your long-term investment performance will be determined by your asset allocation, not the individual investments you make. So what is asset allocation? Simply put, asset allocation is how much you put into stocks, bonds, and cash. I'm going to show you in this video how to arrive at the right asset allocation for you and how to implement it without the help of an investment advisor. I have been doing this for 37 years, and I am here to tell you that you will achieve the same results as I can by following a few simple rules. There are 3 steps to determining asset allocation. Number 1, determine how much risk you're willing to take. Number 2, find the allocation that matches your risk tolerance. Number 3, match your investments to the allocation you have chosen. Let's go back. How do you decide how much risk you want to take? You can do this by comparing different portfolio allocations and comparing the worst case and average case. For example, let's compare 3 different portfolios. Here we have 3 portfolios, balanced, aggressive, and conservative. The balanced portfolio is 30% bonds and 70% stocks, split 40-30 between the NASDAQ 100 and the S&P 500. The aggressive portfolio is 100% stocks, split between the same 2 indexes and the conservative portfolio, which is 50% bonds and 50% stocks. Now, we will compare them over the last 16 years, which includes the last major recession. Over the last 16 years, the balanced portfolio averaged 8.74% per year. The risk level measured by standard deviation was 11.5%. Standard deviation is the amount of fluctuation around the mean or average. The more risk, the higher the number. The maximum drawdown was 28.96%. This is how much you could have lost if you were talented enough to get in and out at the exact wrong time. As you can see, the aggressive portfolio generated a much higher return, but at a price. The standard deviation is higher, but the maximum drawdown is downright ugly. The bottom line is, are you willing to suffer a potential 44.25% loss in order to earn an additional 3% per year? Here's a better question. Is taking more risk efficient? We will look at efficiency in a moment. Lastly, we have the conservative portfolio. Clearly, the return and risk levels are lower. In order to answer the question of how much risk you are comfortable taking, you must understand how much reward you are receiving or potentially receiving for risking your capital. In a moment, all these pieces are going to fit together. Stay with me. This chart compared hundreds of portfolio combinations to the components themselves. The vertical legend represents potential return, and the horizontal legend is the risk level. The blue line is the returns of these various portfolios, starting at very conservative and going to very aggressive. Now look at the short-term bond fund. It is terribly inefficient. It has very little return or risk. Now look at the QQQ or NASDAQ 100. It is 100% tech stocks. It is off the charts, both in terms of risk and return. Lastly, look at the proposed portfolio. It is about 60% stocks and has similar returns to the S&P, which is 100% stocks. The lesson here is that 100% stocks may have the highest return, but is not the most efficient. You only need 3 or 4 investments in your total portfolio. Adding 10 or 15 will not provide a higher return or less risk, period. This concludes our lesson on asset allocation and why you don't need to rely on investment advisors.